Cody Agee, welcome to Acquiring Minds.
Thank you, Will. Happy to be here.
Cody, you're about 6 months into your ownership of a food safety and testing business. So food that makes it to consumers' shelves passes through your lab to get there. The business is in cow country, Tulare, California, and you moved to the area to buy the business. So let's get into it. Let's hear all about this. Background first, please, Cody. Tell us a little bit about yourself.
Yep, perfect. Yeah, so grew up in Southern California, San Diego. Pretty much every guy in my family is sort of blue collar and, worked in construction, kind of most of their lives. And that includes my dad, who, effectively graduated high school and started working with his hands. So, I grew up kind of out on job sites, sweeping floors and hauling, debris to, from here to there and all that. So, more or less, fairly blue collar upbringing. I would say my dad built, reasonably successful, business in San Diego. And I think growing up, I kind of felt like, I learned that you obviously need to work hard and, apply yourself, to kind of, to be successful, but not only that, but learn how to run a business and, sort of, you want to point yourself in the right direction. If that makes sense. Chose to study finance and also started learning Chinese. So I, when I went to college, this was 2010, China was this fast growing emerging economy. And, there's a lot of people writing about how it could be sort of the superpower of the 21st century type of thing. So
yep,
I felt like, well, if I'm going into business, this couldn't be a bad language to learn a bit about. So I
finance and Mandarin, killer combination.
Yeah, that's right. And then I ended up living in Beijing for about 6 months, my junior year of college. So it's pretty much my college experience in a nutshell, I'd say. Yep.
Great. And so to be clear on your interest about kind of learning how to operate a business, one of the things I recall you also saying from growing up was that you were exposed to really wealthy people.
Yeah, that's right. So, effectively, the specific business that my dad runs is sort of like a single family residential home builder. And, it's primarily building, if people know San Diego well, there's enclaves like La Jolla, Rancho Santa Fe, Del Mar. These are like some pretty high-end neighborhoods. And so people are building $5, $10, $20 million homes. And so I just want to be clear that my dad's not, living in one of these homes, but growing up, we worked on a lot of these houses. Yep. And it's just eye-opening, right? You see, it's just, I think anyone's natural instinct, if you see somebody that can afford to build a $20 million house, you're like, how the heck did they get themselves in a position to do that, right? And right. So it's not just, I guess, the takeaway was it's not just waking up early at 6 a.m., getting to work, like working your butt off and like doing, like, it's that plus doing it in the right way and kind of pointing your ship in the right, before I was thinking of good analogies like yesterday, it's like, before we hit launch on the rocket, like make sure it's pointed, to the moon and not sideways or something. Right. So,
because a couple degrees of difference can matter a lot over time.
Yep.
It's a great insight because you can work really hard in life and even in business, small business, for example, and spin your wheels, or at least not do as well as other people who are working no harder than you. So picking the right game is a big part of things. So it sounds like you intuited that early on.
Exactly. Fast forward, kind of post graduation, I just basically hustled my way into a job, back in New York, with JP Morgan doing investment banking.
Now, how do you turn your attention to search?
So I spent most of my time JP Morgan covering these public REITs. I was I also did a rotational program for 1 year in San Francisco, where they sent me to San Francisco to work in kind of the technology group. And so I also was there and got to cover some, semiconductor companies, software companies. The reason I mentioned that is when I was there, I had sat next to a guy. His name's Anthony Runco. We went and got a coffee, and he said, "Hey, I'm gonna leave in 6 months, and I'm gonna go buy a business." And so that was, my first introduction into the world of search. And so I think that was 2018, probably. Mm-hmm. And so Anthony, he actually partnered with another guy named Eric Leach, who also worked at JP Morgan. And so they went out and did a partnered traditional search together. And they actually just exited this last year and had a really big, successful kind of outcome. So that's pretty exciting to see from, soup to nuts, so to speak, going from working in a cubicle to being a multimillionaire. So
absolutely.
Not a bad thing.
And how did it land on you when he told you he was going to buy a business?
I think, like anyone says, it just doesn't make any sense at first. You're just kind of like, how can you do that with no experience, with no money? Like, what do you bring to the table that would, I work next
to you, Anthony. What do you bring to the table? But all right, but you start looking into search. I guess this whets your appetite or piques your interest, and you look into it and go down the rabbit hole. How does this first exposure to it become a serious path for you?
Most people don't last 5 years working in investment banking. It's usually, 2 to 3 years, and then you kind of move on to the next thing. So I was kind of thinking, what's next, right? And I, start the whole startup, the idea of a startup, and just like sitting down and thinking of a problem and trying to build a company around it just didn't really, resonate with me. And so, I mean, it made a lot of sense because I guess, in investment banking, you're pretty familiar with, you have this company here and you want to buy it, and you're going to need to raise some debt financing and some equity and this and that. And so, you like fairly, it makes sense to me, I guess, just how I'd been trained and my brain was wired that you could kind of structure, some kind of deal.
So what did you do?
Well, I mean, started like everyone else, right? It's, you read the HBR guide, buy a small business, buy then build. I listened to, quite a few podcasts and things and reached out to a lot of searchers. I basically had identified that the big two business schools that, especially 5 years ago, that were pumping out a lot of searchers were, Stanford GSB and Harvard Business School.
What happened with your applications to those schools? I like it, Cody. You learn what the best is, and then you shoot for it. Good for you.
Yep. So applied. So I applied to. I'm trying to think of the years. I'm older than I'd like to admit now, but I think probably 2020, somewhere around there. Applied to Harvard and to Stanford. I got interviewed at an interview invitation to HBS. And so for those of you that don't know, basically at either of these business schools, once you get an invite to interview, you have basically a 50-50 chance to get admitted at that point. So, the odds are like reasonable chance that, you can get in. And so I did the interview, waited. I ended up getting waitlisted, which is like, they literally write you a letter saying, you're qualified to be here, but we don't have a seat for you at this time. Like, let us, anyways, that was tough. Waiting, kind of waited around, and then ultimately got dinged. Didn't get admitted.
This is for both?
That was for Harvard, HBS. And so you get that close, and you're like, well, I'll probably give it another go next fall and reapply, right? So did the same thing, reapplied to HBS and to GSB. I got it interviewed for both this time, not just Harvard, but Stanford as well. You do my interviews, don't get into both. I get dinged by both. And so the more I thought about it, probably don't need an MBA to run a search. especially if you want to do a self-funded search. I will also mention with business school, like I did have a bit of a chip on my shoulder about how much effort I had to put in to kind of make it into the seat at JP Morgan, and sort of like the value of having kind of this blue chip resume and all that. I will say I had a little bit of a chip on my shoulder about that, and I wouldn't have minded just kind of having that stamp, this sort of proverbial stamp of approval, if you will.
I will say that I actually think this is a good lesson selfishly for the audience, because you did a search anyway. You didn't go to Harvard or Stanford. And one thing the audience, regular listeners will have heard me said is I don't want people to think there is such an overrepresentation of people in search who've gone to name brand business schools. I don't want people to think that if you have not gone to one of those business schools, you cannot do this. Now, you do also have investment banking pedigree, so you're not the perfect example, because you are coming from a deep financial roots. But still, the fact that you proceeded to do this without going through HBS or GSP, let that be an example that you don't need to, that others listening don't need to. So,
and I was just going to jump in quick, but I listened to the episode you did recently with John Wilson, and I just found that to be an amazing story, right? And he, just kind of grew up around a trade and just kind of jumped in to his waist in it, kind of thing, and he's sounds like having a pretty in a pretty good spot there. So,
great call out, yes. And I think that part of the appeal of search actually is that it's, I don't want to overstate this and suggest that it's, totally egalitarian and open to everybody. Of course, there are a lot of things about search that probably filter out people and they wouldn't be able to do it. Namely, having a little capital certainly helps. There are people who do it with zero capital, but that would make it a lot harder. And having financial chops does help get a deal done for sure. So those who don't know the first thing about finance have a bit of a learning curve ahead of them that you probably didn't.
Yep.
But with those two caveats, I feel like search is actually this amazing path that is pretty open to anybody with the gumption to really hammer at it. Anyway.
That actually good point you make there. And one of the things I wanted to, just in my, feel like what I've learned so far and kind of just give my 2 cents to listeners is that there's no one background to have, in order to do a search successfully. And then there's not a right size of a business, and there's not a right industry. It's a very personal, I feel like that's, kind of a high level statement, but yeah, it's a very personal decision, and you need to assess, for example, I'll just create like a fictional background, but say like, don't come from, the investment banking finance world, but you have skill, you're a skilled kind of tradesman, maybe you worked for, an HVAC business for 5-10 years, and like, can you go out and buy like a $400,000 SD HVAC business and do it successfully? Like probably, right?
Right. Well, and the other thing is like, that person is probably way better prepared to run that business than somebody coming out of Goldman Sachs HBS. So we also overstate the value, I think, of the financial background, because it's most relevant getting a deal done, and that is a big part of this. But it's much less relevant as you proceed. Yes, understanding the language of business, i.e., accounting and finance, helps be a better operator. But there's so much more to being an operator than that, and you can get away without knowing that as an operator, as most blue collar business owners, founders are. Very few of the original guys and gals who built these businesses have any financial literacy. Excuse me, high finance literacy. So anyway, and actually, I'll want to circle back on that, Cody, and ask you that question.
Okay.
Do you feel to what degree do you feel your years at JP Morgan are helping you now as an operator? But we'll get there. All right. So where are we? You set out now to do your self-funded search.
That's right. Yep. So
what year is it, and what do your parameters look like?
So it'd be fall of 2022. Fall of 2022. We had been living in New York for my wife and I for most of our 20s. I will mention, by the way, so I met my wife in New York. She was an interpreter at the United Nations, and so like super successful girl. She grew up in, I'll say, Eastern Europe, I guess, and moved to the US and got a job there, and so she's super successful. And basically, I wanted to do a search in California, kind of closer to home, and so I convinced her to leave her job, and I obviously left my job, so we were kind of burn the boats and all in on this search, basically. So I have to give her some credit for letting me
saying yes.
convince her to do this, because it's not an easy thing. So
thank you, wife. Shout out to you, wife.
Yep, it's really exactly.
Yeah.
So anyways, fall of 22, basically starting a self-funded search. Have that built a cliche website. Recurring revenue, $1 million of EBITDA. California, and on my way, basically. Started searching. I'll say that something that was important to me in my search was at that time, right, late 22 going into early 2023, the Fed had just raised rates at sort of a unprecedented level. And if you read the Wall Street Journal or you watch CNBC or wherever you consume financial news, like everyone's talking about, is there going to be a big recession or not? And so the context of looking at small businesses, everyone had a record 2022 year of performance, and the question was, of all these businesses I'm looking at buying, so I was fairly industry agnostic. And then was looking kind of in the California area, or somewhere in a reasonable radius close to family. Which of these businesses would do well during a recession, right? Because if you're going out and using an SBA loan to buy a business, you got to service the debt, and if you buy a business and the EBITDA halves, like you're gonna find yourself in trouble real quick, right? So. Anyway, so that was kind of top of mind for me. Which of these businesses I'm looking at is just going to be, stable and can kind of survive. And I'll caveat, because I was doing self-funded search, and I think a lot of your listeners know this. When you're looking at kind of a self-funded search type deal, you basically capped how much you could pay for the business, because you're going to be using SBA financing, which the cap's $5 million. So can't buy a big business, right? You're going to buy a little bit smaller relative to a traditional search model. And, consequently, like the multiples you're going to pay be a little bit lower. And anyways, as a result, was not looking for this high growth, 50% year over year growth type company that, would trade for, 8 times EBITDA or something, right? You're looking at some kind of durable business that's been around a long time, and maybe it's growing 3% a year. That works for the self-funded search model, right? So something like that durable, and that I felt like I could step into and buy, and kind of plus or minus $1 million of cash
flow. And you didn't
flow.
Want a high growth because why?
Well, I mean, if I could buy a high growth business for 4 times EBITDA, I would, but they just don't trade. They probably don't trade at that kind of multiple, right? So,
so you were price constrained, as everybody kind of is, unless they did a traditional search fund or have some kind of other backing, right? So you've decided on a self-funded search, and you're geographically constrained. You want to be in California, closer to home, or at least closer to home, not necessarily in the San Diego area where you're from. So tell us a little bit about the search and then how you found the business that you did.
Yep. Perfect. Yeah. So I started the search fall of 22, and if you talk to other searchers, everyone's got an opinion about whether you should just do it through broker channels or if you should try and do some cold outreach and, find a business for sale kind of on your own. I tried both, and I ended up submitting 15 LOIs over a course of 12 months, and all 15 were through broker deals. So just in my personal experience, I had much better luck just getting deal flow through brokers. It's kind of funny, but I remember sitting down. You're always thinking as a searcher, like, what is my criteria? What do I want? And you're always refining it and thinking about it. And I remember probably 2 weeks before this business got listed, I said to myself, and this is in the context of, a potentially looming recession, right? Don't know if at this point in time, like what the economy is going to look like in 6 months. So, if there is a recession, what do people need? What are services and things that people are going to rely on no matter what, right? And it's sort of like, well, you need food, you need shelter, you need water, just the basic human necessities, right? And I remember thinking, if someone goes in a grocery store, I bet the food, like no matter what, somebody needs to make sure the food's safe. And I bet there's some kind of business out there that, is doing testing and this is a true story. And 2 weeks later, Sierra Dairy Laboratory got listed on, by Transworld Business Brokers. So
you manifested this. It sounds like.
Exactly. So everyone close your eyes and wish.
Sierra Dairy Laboratory. Tell us about the business.
Yeah. So Sierra Dairy Laboratory was started in 1989 by a gentleman named Bill Hartman. He grew up in Kansas. Big, obviously the kind of ag industry there is big. Went to Kansas State. He got a bachelor's degree and then got recruited to come out to California and work in one of these dairy plants here in the California Central Valley. Did that for a few years and then just kind of had that itch to do, his own thing. And so he set up just a little kind of one-man dairy testing lab, business and, kind of grew it from there. So today, or at least at the time of, when he was going to sell it, it's, roughly 25 person business, works with most of the main kind of key dairy companies and, dairies and, in the industry, especially in California. So a lot of kind of blue chip customers. And
what does that mean, Cody? Give us kind of the flow of here and where perfect. You fit into the value chain.
So we do work with dairies, for example, and the dairy is pretty simple, right? You're a guy with some land. He's got a bunch of cows. They produce in milk, and you want to, for a variety of reasons, you may want your milk tested. One of the key tests we're doing is looking at bacteria levels, which is just looking at how much bacteria is in the milk, which is kind of a proxy for quality and safety, basically. And the primary reason you get bacteria in milk is if you're just not cleaning up after the cows and they have kind of feces on the ground and they're stepping in it, that creates conditions for kind of bacteria get into milk. So just running kind of a clean dairy operation kind of helps eliminate all that. So, but anyway, so we do basically out getting samples from these dairies. Right. And then kind of how the industry works. You have some people who run a one-off dairy. There are also dairy co-ops where you have 300 dairies who are all part of this kind of, think of it like OPEC, kind of like not a cartel, but they're kind of
consortium. Let's say they're kind softer term.
They're a consortium, a dairy consortium. And, so sometimes our customer is the co-op itself. And so we're getting one-off samples from all of the dairies that are in the co-op, right?
Yeah.
And then on top of that, you've got dairy plants. And so raw milk will last about 48 hours from when it comes out of the cow to when, it'll go bad. And so you need very quickly to be able to get milk out of a cow and turn it into a food product, right? And so kind of littered throughout this California Central Valley here, there are a lot of plants where you're making any kind of dairy product, ice cream, cheese, consumable milk, yogurt. The list goes on basically. And so we're also out at these plants picking up samples as well. And so just to give you a sense for the size of our operation, we're doing around 600,000 tests a year. And so we're doing, we're getting ice chests.
200 a day, give or take?
No, it'll be in the thousands. Yeah, so we're doing thousands of tests a day. So we have a lot of igloo ice chests and an ice machine working around the clock to keep things cool. So,
and so so obviously there's CapEx in this business. There's a lab, which is key to the functioning of the whole thing. And we'll get to that, and I guess real estate we'll also get to that. But before we do, give us some more numbers around the business. You said 25 employees. Can you give us a sense of revenue, profitability? Yeah, let's start there.
Yeah, so I would say 25 employees. I would just say, like, in terms of size of the business, in order for me to buy it, I had to use a good portion of the SBA. The SBA kind of lending limit, which is $5 million. So it used up a good portion of that. And then the way I structured the deal was kind of you call it 75% of the purchase price was SBA financing, and the remainder was kind of a combination of equity and seller paper.
Okay.
So and then I would say kind of margin profile, like really like pretty strong margins. Would love to share more with the audience, but I'm just being coy, for a couple of different reasons. But good kind of healthy margin profile, kind of better than a distributor, that's doing 10%, for example. Let's say.
and just for the regular listeners should have a sense of what good and bad margins look like, but single-digit margins would be considered very tight. There are business industries that have single-digit margins and survive, but those are tight. 10% is distributors, still quite tight. Mid-teens, you start getting a little roomier, but still considered on the tighter end of the spectrum. 20 or high teens 20 is kind of where a lot of small businesses sit. So this is very imprecise, but kind of consider that an average or a good median. Like if you got there, you're fine, you're good. And you shouldn't expect a lot more. If you can get north of 20, you're into pretty good territory. Those would be considered roomy margins. 30% would be a really high margin business. Did I get that right? Would you say, Cody?
Yeah, that's right. Yeah. So we're sitting in good,
the good territory, north of 20.
And the good territory there. Yep, exactly.
Great. And what would you say about the quality of revenue? I've decided to stop asking about recurring versus not, because that's a crude way to think about it. It's really the quality of the revenue a business has. How good or bad quality is your revenue?
It's pretty high quality. It's not as it's funny, like when you have to actually double click into recurring revenue and then start to. It's not as simple as like black or white, like recurring or non recurring, right? But I can describe kind of how our business is. Like, we have a lot of our customers we've worked with for decades, where every day or every week we're doing the same work for them, and we've been doing that for since before year 2000. So we have a lot of longtime customers that we can rely on to kind of keep coming back and using us for the service. So it's a pretty stable, and that was sort of one of the real selling points, things I liked about the business was just how reliable and kind of durable the business had been kind of over a long period of time.
Well, so that plus the recession resistance. So it's kind of, you are tightly coupled with demand for dairy, which probably doesn't fluctuate very much, or maybe at the margins it does, but let's call that a pretty constant demand regardless of the macroeconomic environment. And your piece of that is, safety. That's how. So you're very tightly coupled to it, because milk is only, all milk producers or dairy producers are going to have to go through somebody like you. So pretty recession resistant, and these very long-standing contracts where there's just basically a constant flow of milk that you need to test. So while it isn't pure contracted revenue, it's very, very reoccurring to the tune of decades. So, and by the way, pretty high margin. So this is high quality revenue. This sounds like a very sturdy, high quality, recession resistant, decades old business. I'm liking it a lot.
Yep. No, I text friends and investors every day, or not every day, but pretty often. And I pinch myself. Like I feel like I really, and I'll say knock on wood, but it's a great company with a really good reputation, and there's a lot to like about it, right? Kind of like that's actually one of my questions on my initial question list for the seller was how did this business perform, in like 2008, 2009, of when we had the last big recession. And he's like, you know what, Cody, that was the best year we ever had.
Really?
And the reason is the price of milk was through the roof, and people were just milking he's like, in his words, people were milking anything they could milk, to sell at that price. And so I actually also ran, so that was good, right? And then I was able to get revenue data from him dating back to probably 2000 on the business. And I ran kind of a regression of the business's revenue against the price of milk, the average price of milk in that year. And it's basically non-correlated, which I found very interesting, which is that like no matter the price of milk, like, well, like he did well in this one year, but like if the price of milk goes down quite a bit, you didn't really see like a huge drop in volume that you're getting from producers, because, whether the price of milk is $10 or, $30, like if it's coming out of the cow, you're still going to process it. You're still going to get something for it. Right. And so you still need to test it. So it's,
well, yeah, except, I mean, the question there would be, I think, two things. First, but that also suggests, pricing power, that you have pricing power, and typically there's pricing power when there's not a lot of competition. So do you not have a lot of competition?
We have, so this is kind of another nice thing about this industry and the company is it's regulated. So you need to have the right kind of certifications in order to do the testing. And so that's kind of a, I don't want to offend our landscaping business owners out there, but anyone could go buy a lawnmower and show up at a house and mow the lawn, but not everyone can go get certified by the FDA and ELAP, which is like the water certification board, to do this testing, then buy all the equipment, and you actually have to know how to do it. It's pretty difficult to just have somebody come off the street and try and compete with you. And so our two primary competitors are actually like basically large multinational corporations. One is Eurofins, which is a publicly traded company that does €1.5 billion of EBITDA a year. And then another is called Moreau, which is a French company that, also big company kind of all over the world. And, on one hand, it sounds scary, right? When your two biggest competitors are like these big companies, and you think, well, maybe they could muscle you out of, out of work or whatever. But that's sort of why people come to us, is we're this nimble, kind of smaller company where you get a test. If you have a question on the result, you can call us and we'll pick up the phone and we can talk you through it. And whereas at these other companies, it's like it's like calling Verizon, you want this, press 1. If you want that, press 2. And, if you're a dairy farmer, you're just like, what the hell? Like, why can't I just like talk to a friggin' human about, my test result? And so that's kind of where we differentiate ourselves relative to our competitors is we're a bit more nimble, kind of high quality of service where you can reach out and chat with us, and then always just having, providing good test results, right? Minimizing as many errors as you can. It's easier to do that when you're not running a, thousands and thousands person type organization. So
yeah. One of the other things just about your relationship to your customers, the dairy producers, is where on their list of expenses you fall, how high. So, always the nice strategic place to sit is to be an essential cost of your customer, but a low cost of your customer, so that when times get tight for them, they go down the list of their biggest expenses, and they may never get to you. They're going to try to negotiate with their bigger suppliers or their bigger vendors sooner. So where do you sit on that list? Are you a big expense for a dairy producer, or not such a big expense?
Yeah, so we're kind of high value and high value service to the customer, but low cost. Which is obviously a good place to be. And
that's where,
for some of your listeners, if they're kind of in the weeds of like private equity backed companies that have done very well, there's a business called TransDigm, which makes like aftermarket airplane parts basically. And so, if you think of like an airplane and, providing parts to, that go on an airplane, like you don't want to be the person that's building the motor, because that's like a big expensive piece of equipment, right? And then they're like, if you wanted to reduce your costs as an airplane manufacturer, that's probably the first place you'd go, right? But if you make the seatbelt on the plane, it doesn't cost much, and also like you want the seatbelt to work and function properly, because that's like a pretty important thing. So, kind of similar thing here. Like we provide a super important service. And it's a microscopic, it's it's a very small cost relative to their operations, because they got, if you're one of these big dairy co-ops, you're running these huge plants. You have like the trucking expense of like moving all this milk everywhere is enormous. You obviously have to pay the farmers for the milk as well. So there's a lot of other costs for our customers that, we're not the first place they're going to go when they're looking to clean up their P&L a little bit.
Well, what's not to like? And now one thing that can be challenging for a searcher who finds a business that he or she likes is where that business is located. This is in California, so that's awesome. Yep. You wanted to be in California, but you did have to move for the business. Tell us now about the decision to do that, where you live, and maybe bigger picture. Like, this is so entwined in its market of cow country here. Like, does this mean that you and your selfless wife are going to be here need to be in this town for the long term, or just during a transition, or what? Give us a picture of that.
Yeah. So the business, so just from the start, so the business is located in Tulare, which, for those of you, most of you listening won't know where that is. It's a town in California, about 30,000 people. And as the seller of the business described to me, it's the mecca of dairy in the United States. So it's like, I think Tulare County has the most cows. So
are you guys there for the long term, or for the duration of your ownership of this business?
I would say, we like the area. It's new. We, you have no idea like what, where your life's going to take you in 5 or 10 years. But, sure. At least at this point in time, I don't, we're close enough to family. I don't see any reason to want to move. But, I will say this, like we haven't touched on the team and stuff that we have in place, but I probably could live anywhere I wanted, and this business would probably do just fine without me. So,
perfect segue, Cody. So let's hear about that team in another one of the strengths of the business. And then we got to get in the weeds here and more about kind of the terms of your actual deal, which people will have an opportunity to learn a lot from. So what does management look like at this business? Why is your team so strong that you actually might be able to run this thing from over Zoom?
Yep. So the seller, so Bill Hartman, the gentleman who started the business, he, reason for selling, he's 68 and wanted to kind of, just fully unplug from the business. And he knew that, going back 5 or 10 years, he knew that he would, want to sell the business someday. And I think he said his accountant advised him that he should try to remove himself as much as possible from the operations of it to make it kind of more sellable, basically.
Sage advice.
And so he sort of slowly just passed on responsibility to, other employees of the business. And, especially two of them, Natalie and Melinda, kind of who help run the lab here. Natalie works more kind of on, she's more interfacing with a lot of the employees daily and doing sort of like HR functions, and is really focused on customers. She basically knows everyone, it seems like, kind of in the area sort of thing. And then Melinda is sort of like our technical guru who does a lot of the compliance stuff. And, if any equipment breaks down, she's it's not her first rodeo on getting it fixed, sort of thing. So I rely heavily on those two, in order to keep the place going. And that was obviously in kind of underwriting the deal important to, make sure that, hey, like, do you like me? And you see yourself kind of staying on and wanting to work here, going forward. And so there was a little bit of courting and getting to know each other and all that ahead of time, prior to closing. So,
Cody, I don't know if you saying do you like me was kind of capturing the essence of the process, or did you actually ask that? I actually love that question. Did you ask that?
I wouldn't say I directly asked them, do you like me? But I mean, I definitely asked them. I just told them, like, if you have any concerns about me, like buying the business and coming in and you not wanting to work here, just tell me. And I just won't buy the business, because we all know that this probably won't work without, especially the two of them. This business is super important to them. It's their life. Melinda's worked here since Bill basically started it in early 90s. She's worked here since the early 90s. So like the business is kind of her baby as well. And, same with Natalie. She's worked here for decades.
Let's talk a little bit about the transaction terms. You've already shared what you can. But there was a little bit of, It was a process to buy this business.
February of 2023, the business got listed. I manifested this business into biz buy sell. And, anyways, spent a couple weeks, spoke with the seller, put out an offer that I felt, should be competitive, but it was also something I could, finance and get done. Submitted an offer probably on like a Friday. Saturday, Sunday go by, don't hear back from the broker. Monday goes by, still don't hear, and starting to feel a little more nervous. And then I think by Tuesday he said, "Hey, we're going to go with another party on the deal." And I love this business. This was the best business that I had seen in my search, and so that was. Doesn't feel good to see something like this slip away. And I remember telling some of my other searcher friends and other friends and former colleagues, just talk about the business. And I think one of my now investors, his name's Dino Sawaya, and he's like, "Cody, you like stay in this thing. These deals can fall apart, and you never know what can happen. So why don't you just go submit another LOI on it right now, increase the price a little bit and see if anything happens." And so I unsolicited just bumped up my offer price a little bit, and the broker calls me and goes, "Hey, I'm glad you reached out, because like this thing looks like it's kind of falling through with this original party here." And so, kind of just said, "Hey, hang tight, but it may come back on market." So
boy, did that investor earn their salt.
Yep.
That was great advice. Fantastic.
So yeah, you could see Dino Sawai. He's on Twitter or X, and he's got a lot of good advice and content. So, and he was an investor in the business. So I think very, very highly of him. But anyway, so yeah, effectively what had gone on, they'd gone under LOI with a strategic buyer, company
strategic.
That owns,
so one of these other two giants?
Not one of those two actually, but another lab business that owns 100 labs across the country, but didn't do a lot of dairy testing specifically, but other kinds of food testing and other testing verticals as well. And I don't know. I only know what I've been told, so I don't actually know the truth. But at least what I've been told is they came down and looked at the business, and they said, and so part of the deal was the owner Bill owns the business and the building. He wanted to sell both. It's kind of like a package deal, and these guys flew down and said, actually, we don't want to buy the building. We only want to buy the business. And we want to buy the business, and then we want to put everyone, an hour north at this other lab we have, an hour north. And that, didn't work, obviously, because Bill wanted to retire and he wanted to sell the building. And then, for Natalie and Melinda, who, they worked here their entire lives, all of a sudden, and all the other employees, like all of a sudden, this guy is saying, hey, you're going to need to uproot your lives and your family's lives to go, work at this lab up there. And so that didn't work for them. And so, yeah, anyways, it just didn't pan out for obvious reasons.
And so you were hanging around the hoop, as we say, and you increased your offer, and you were willing to buy the real estate, keep it in Tulare.
Yep.
So that all of a sudden makes you a very appealing buyer. Now having kind of seen what the other offer was out there for the seller. So how does it go with the seller?
So frankly, we had a great relationship. Bill, I found him to be, you hear all these horror stories about people with bad experiences with sellers and, all kinds of personality complexes and changes they change their mind perhaps about whether they want to sell or not. But Bill's pretty committed to selling, and he was a fairly good sport through most of the process. So no big complaints. We did have to revisit price. Once I had gotten into more financial diligence, we did have to revisit price, and thankfully Bill was kind of amenable to making something happen that kind of worked for both of us. So
revisiting price, was it significant? Can you share what the offer? Well, I guess you said you were.
Yeah, I can say it was
didn't max out the SBA loan, but we're in that direction, so we can.
Yeah.
Mm-hmm. And can you tell us what the multiple was?
Yeah, it was more than. Yeah, so I can say the price reduction was more than 10% of the purchase price, which was significant.
Yeah.
And the reason that we had gotten into that place is, the seller, or the broker rather, had put together some preliminary financials, and just none of the add backs are substantiated. And so, as a buyer, you're going, well, if you're telling me that, this EBITDA or this SDE, this cash flow, if that's true, this is what I can pay you. And then obviously you get in there and, like really get in the weeds of, what numbers look like. And,
and so were you very kind of, spelling out what your logic was to the seller, to Bill? And so to soften the blow of the retrading, like talk us through that a little bit.
Yeah. I mean, I will say, Bill was a great seller, but I'll give myself a little bit of credit as well. Because I was trying to coach him through the whole process of like, once we're under LOI, these are all the steps we need to go through to get to closing. One of them is we're going to commission this quality of earnings report, which is essentially, a CPA or kind of an accounting firm is going to come in and make sure that these numbers are what they say they are. The reason that's important is a lender is going to give me a certain amount of money based on what those numbers say. So we need to figure out, are these numbers true? And kind of go from there, right? And so we basically were working with him on this quality of earnings process and kind of going like, hey, here's what the number is right now. Is there anything we're missing, or did we capture that right? And so I tried to make sure that he felt like very included in that process, and he even knew what the results of the quality of earnings report were. And so it kind of just bring them along with us. And then eventually we got to the point where like, this is just, I can't get a bank to lend probably on what I offered. And I personally don't feel comfortable.
What you initially offered before you.
Yep.
Yeah.
Exactly.
So you say to him, you've explained to him how banks are going to think about this. They're going to look at the Q of E, quality of earnings. And you're like, I can't, at this price, even if I wanted to pay this, a third party who's going to be invested in this, namely the bank, isn't going to lend at this value.
Yeah, exactly. That's right. And so I will say a few days went by, we didn't talk, and I know he was not thrilled about it. But, ultimately was, pretty good sport, and we ended up agreeing on kind of a revised, purchase price. And I think I upped the seller note, interest a little bit, just as a little throwing a bone a little bit on that, for example. So we kind of revised structure a little bit and, reduced the price, and ultimately came to an agreement. And then from there, basically off to the races, where we, kind of got legal going and started drafting purchase documents and all that. And then I got my equity raise, process going and kicked that in full gear.
And the investors, these were people you found on Twitter?
So this may sound pretty crazy to everyone. I would say over half of my investors I met on X or on Twitter in the last 12 months. Yeah. So it's a pretty powerful, kind of medium of exchange, or place to meet people. Yeah.
Mm-hmm. Yep. Well, you're not the first, so I'm not surprised to hear that, actually. And just, Cody, going back to how you kind of held Bill's hand, for lack of a better phrase, do you feel like that it was something specific to your deal, or do you feel like that's generalizable advice that really kind of walking the seller, assuming the seller has never done this before, walking the seller through the incentives and how all the parties interact is something that you tell basically any searcher to do? Because it sounds like it was successful in your case, and indeed key to the success of the deal.
No, I think it's, there's no reason not to be, assuming everyone's acting in good faith, you should always just be as, communicate as kind of straightforward as possible. Yeah. And, it's in everyone's interest, right? Because I'd rather just talk about upfront all of the potential, because there's certain things you just know are going to come up at some point. Like one of the kind of nuances of getting an SBA loan is the seller has to sign a subordination agreement where they're saying, this seller note you're giving me is subordinate to the bank. So if something bad happens, the bank is, in first position, right, to kind of recover any losses. And some people don't have that conversation up front, and then you get to a week or two before closing and you put that paper in front of them and they're like, I'm not signing that. I want my money, right? So just small examples, like, that's just one example, but any of those sorts of things where you can eliminate surprises, the better. And I actually had something like that, which caused a little bit of issue towards closing on mine, where I ultimately had to end up personally guaranteeing the seller note on my deal. And in the LOI, it clearly stated that the note is unsecured. So, I thought that it was pretty clear that I shouldn't have to personally guarantee it, but we were 2 weeks before closing, and it created a huge hurdle. And ultimately, it's like, well, if I'm personally guaranteeing all this SBA debt, what's another, couple $100,000 of seller note that's already subordinated.
And is that unusual, Cody? I should know this. If seller notes are typically personally guaranteed?
I think depending on who you ask, they tell you that. I don't think it's unreasonable to ask, but it's also
a point of negotiation.
I think different people would have different opinions on it, but
okay.
If you think about it, you're already personally guaranteeing the SBA debt, and then the seller note is subordinate to the bank. So in the event, the worst happens, the bank probably takes anything anyways, and then they would just tell the seller that there's not, even though it's guaranteed, there's nothing there, right? So I don't know. So anyways, it's not fun, but I don't really even think about it anymore. Like once you get to closing, you're thinking about running the business and all that. So it's not something that's a real big burden for me, I think.
Well, your point about the seller note being subordinated to the bank's loan is, I have heard that blow up deals where the seller was caught off guard by that, hated it, and tanked the deal. So great point that something like that should be communicated early and often. Now, talk to us a little bit about the real estate here. Well, first of all, let's do real estate, and then let's hear about assets of the business. I mean, in a lab, I think lots of equipment. Is that actually the case? But first, real estate.
Yep. Yeah. So I bought not only the business, Sierra Dairy Laboratory, but also the building where the lab here is located. And so we have it's basically like two buildings and a parking lot. It's roughly 10,000 square feet in size. So like pretty sizable operation. This building, if it was in San Diego or Los Angeles, would be worth much more than the business. Because we're here kind of in cow country, as you described it. It's the business, the way kind of the way it sort of pencils out is the business is worth, let's call it 60-30. Yeah. So, 65% of the purchase was business purchase related. And then the remainder was kind of allocated to real estate. Okay.
All right. And that means that you have the blended loan. Walk people through that for the uninitiated.
Yeah. So so this is kind of a cool aspect of the SBA. So if you're getting an SBA loan and you're buying a business and the building, and the business is the majority of the purchase price, so greater than 51%, the way the bank will look at that is they'll look at the total purchase price that you're offering, and they'll go get an appraisal on the building, and then they'll look at the differential between what you're paying in total and the appraisal on the building, and kind of come up with like a sum of the parts of what you're paying for, for the business and the building.
Right.
The business, and then basically they'll apply that percentage, between the business and the building. So in my case, 65% of the loan is related to the business, and then the 35 to the building. And so you get a 10-year amortization, meaning the loan is due in 10 years on the business portion, and then you get 25 on the real estate. And so when you kind of blend that all together, I basically get a 16-year, term loan on the business, which is higher than the 10-year amortization that most people would get if you're just buying a business alone. And
so most listeners, most guests won't have real estate in their deal, although it's not terribly uncommon. And so they'll do 10 years. We think of the SBA 7A loan in terms of these 10 years. This is a way so your final loan, this blended 25-year amortization for the building, 10-year for the business, but you still have a single loan payment that's amortized over 16 years. So they basically did the math to consolidate it into one single loan, 16 years. So yeah, better terms, or better amortization schedule. So basically lower monthly payment, obviously, which is great. Now, that's when the business is 51% or greater of the total purchase price. In the case where the real estate is 51% or greater, what happens? Which was not your case, but if it had
this is not my case. It's been a little while. I'm like 6 months removed from the nuances of all this, but my understanding is that if you're buying both and the real estate is 51% or greater, that you can get a 25-year term on the entirety of the loan. So you get a 25-year term loan, which would be pretty cool. So if you could find a situation where you can, the building's worth $2 million and the business is worth 1.999 or whatever. There's some pretty interesting things that can happen as a result of that, because the term of the loan's so long. So your payment will be pretty low on the on interest and amort and all that.
As a guest recently said to me, whose interview hasn't aired, at that point it's essentially like you're mortgaging the business. I mean, 25 years is close to the standard U.S. mortgage of 30 years. It's like you've mortgaged a business, which is even more incredible than the already pretty incredible 10-year AMs that we get from the SBA 7A loan. So that's amazing if you can get it. That is quite rare. But I actually have a guest who coming up, different guest actually coming up who was able to get that. So thank you for that. Now we're going to be wrapping up here in just a second, but a couple still things I want to hit, Cody. In our pre-call, one of the terms you used that I actually hadn't yet heard, and then one of these situations where I then proceeded to hear it everywhere, but I hadn't yet, was EBITDAR. EBITDA with an R at the end, that R being rent. So earnings before all of the things plus earnings before rent. And so tell us what that is, what EBITDAR is and why it's used.
Yep. So typically when you're looking at buying a business, you are referencing EBITDA. And if you're buying a business, typically you're going to be, have a landlord, you have a rent expense. Because I'm buying the business and the building, I basically don't have to pay rent, although technically every month I have two entities and I'm kind of running cash back and forth. It's all owned by the same people and stuff. So effectively don't have a rent expense. And so if you're a bank looking at, how much debt could you put on, this deal, the bank's going to look at EBITDAR because it's EBITDA and then you don't have the R because you don't have any rent being paid. So in the context of basically looking at how, just how much money is the business bringing in, every month, every quarter, every year, EBITDAR is sort of more relevant to the bank. And so in some of the materials I send to my investors, I'm sending out, here's EBITDAR and here's EBITDA. And EBITDAR is important because that's basically how much money did we bring in this month relative to how much our debt service is. And then EBITDA is relevant because, our peers, other labs, for example, in the industry, you can go look at what their EBITDA margins are. And so if you want to compare your business relative to, other businesses in the lab space or other industries, for example, your EBITDA margins are going to be more relevant. So, in the context of Sierra Dairy Lab and the fact that I bought the real estate, we're kind of looking at both, kind of both of those metrics.
But sorry, you'd want to use EBITDAR when comparing your business to the performance of other businesses in the same industry.
No, I would say EBITDA because most like Eurofins is a big public company that's a lab business, and they're going to be reporting EBITDA. And if you go look in their filings, and so you can go see what their EBITDA margins look like. But I don't have that rent expense, and so it's not as relevant because, you know, I don't have rent expense. And so the actual money I'm bringing in is higher than what my EBITDA would be, because that rent expense is not really, you know, it's not really a rent expense.
Great. And so to the lab, so was there a lot of CapEx in this business?
I would say reasonable amount of CapEx. You know, there's some expensive equipment definitely in the lab here, and you know, it's a recurring kind of expense to service it, maintain it, to buy new equipment as well. But with that said, you know, when I'm referencing EBITDA, and I think a lot of people, when looking at other small businesses as well, basically the EBITDA the margins and all that we kind of described, that sort of includes most of the capital expenses that I'm incurring every year. And so you'll see a lot of small business owners, they probably expense, you know, certain items that if you're running a big public company would probably get capitalized and included as like an asset, you know, on your balance sheet. So, anyway,
not in your case.
I would say, yeah. So I would say, yeah, like moderately capital intensive, but you know, it's fine to have CapEx as long as like as long as your EBITDA less CapEx is, you know, maintenance, EBITDA less maintenance CapEx is and you still have a reasonable margin after that, then, you know, it's okay. Right. Yeah. So, yep. So that's the right, we're still making good money after all that.
For the capital that you brought to this deal, you used your 401k. You did not use Rob's, which is the typical method that my guests who need to access the capital in their 401k do use. So, you know, if you take money out of your 401k just straight, there's often there is a big penalty. The idea with the 401k is that it sits in there until retirement. So talk us through your decision to do that.
Yep. Well, yeah, if you listen to, I think this Dave Ramsey guy, he's a popular like personal finance guru. He probably wouldn't approve of this, but so I did use basically all the funds from my 401k to kind of contribute an equity check to the deal. And so, yeah, you do incur kind of a one-time withdrawal penalty, and then it's also a taxable event because you have a lot of pre-tax dollars in the 401k. And so I did have to obviously incur the penalty. However, the way that kind of the deal came together is I bought it obviously end of October, so operated it November, December, basically 2 months of operating history. So, you know, not much time before we had to file taxes. And then, you know, kind of working with my accountant, we elected to bonus depreciate all of the equipment that we have at the lab here, which is approximately $1 million in value. And so you can bonus depreciate 80% of that. So it created a pretty big taxable loss for the year. And because, you know, I bought the business and have it structured as an LLC or a partnership, basically we're able to take that big loss and then apply it to, you know, my share, to my personal return. And so it resulted in not really having to pay, any kind of tax on the dollars that I withdrew. So it, and this is not tax advice. And by the way, just telling you how it worked out, for me. So it wasn't as big of a drain on the amount that I pulled out as, maybe it would in a different situation. So,
but it sounds like you didn't plan it that way. It was just happily working with your accountant. You saw that you had this opportunity and grabbed it. What does bonus depreciate mean?
Bonus depreciate is effectively, say, for example, say you have $1 million of equipment over time that equipment gets used, it becomes less valuable. And, the U.S. government allows you effectively to, for any kind of capital asset to basically write as an expense, that, the value of that asset depreciating over time. And, for whatever reason, in the U.S., you're allowed to elect to depreciate 80% of equipment in just kind of, year one of you owning it effectively. And so in my understanding, encourages people to outlay money to, purchase assets and equipment, as opposed to paying taxes. So,
all right, Cody, my last question is to circle all the way back to the topic where we, discuss the relevance of finance experience or going through an MBA program, a business school, to actually being an operator. So, in your case, those 5 years at JP Morgan, being really in the belly of the investment banking beast, how relevant do you find that experience to your day-to-day as an operator now, not doing the deal, but as an operator?
Yep. Yeah, I would say, as you mentioned, doing the deal, pretty helpful. As an operator, I would say less useful, but still useful, I suppose. At the end of the day, any business, it's revenue, less expenses, equals profit. And so like having an understanding like how to track all that and feel like you kind of have a pulse on the business, I think it's obviously pretty important. So I think having a background there, in finance, that's been helpful. But definitely on the people side, when we have, close to 25 employees, I'm not relying on any of my investment banking skills for really any of that. That I think my ability in doing that comes more from having grown up around a small business or, having played, football through college and, working, you're working in kind of a team setting and encouraging one another and, acting in some kind of leadership form in one way or another. So I would say in terms of managing people, I draw on those experiences more in my day to day. And then the actual technical aspects of how to run a dairy lab. I mean, I have zero experience with any of it. And so I'm, every week I learn a little bit more.
How are you treating that, Cody? I mean, very common theme of the podcast, buying into a business that one knows nothing about, industry that one knows nothing about. This is pretty technical. The end work, the end service being delivered is very technical. And in fact, the whole point of a lab testing business is that the room for error is really, there isn't much room for error because you are basically the backstop of your clients making errors or letting bacteria slip into their milk or whatever it is. So you're really the ones who are, checking the clients and therefore need to be, pretty tight on this stuff. So how do you think about learning this business and, the extent to which technical know-how is something you're going to want to accumulate?
Yep. I mean, I would say I probably could get away with not delving into a lot of the technical stuff just because the business is of a certain size where, I probably could get away with not knowing too much about the like specifics of this test or that test and the methods and all that. But it's something I do want to learn, and I would just say it's a process. It's unreasonable to expect that in 6 months you're all of a sudden going to be this dairy wizard. But just by spending time in the lab every day, you just learn a little bit at a time, and you just keep. I think of it like it's this giant canvas with a bunch of dots, and every day, all of a sudden, like one of the other dots gets connected, and it starts to make more and more sense as time goes by. Yeah. So.
I like that.
And maybe I always think like, well, I should know more by now, but I also don't want to try and beat myself up too much about, not knowing, don't know what I don't know. So keep moving in that direction. And one of the cool, kind of first things, people say don't change too much about the business, the first 3, 6, 12 months. One of the first kind of big changes or things we're going to do is implement a like a lab ERP, basically like a software system that, you bring a test in, goes into the system, and then it lives there, and then the results are there. The report gets created automatically. You take that report, you can ship it directly to the customer from this portal, for example. And so I'm going to be, pretty heavily involved in getting that up and running. And so that'll be a good way to force me to really understand, step by step, how does each test work and how do our processes work? So,
yeah, exactly. Not to mention, hopefully, a huge boon for efficiency at the business.
100%. Yep. So this is one of these classic paper-based, somebody comes in, print the paper, write the, what you want, and then that goes here. Somebody, writes out another paper, and then, there's a lot of paper getting moved around and all that. So one of these classic businesses that can use a little, just some technology upgrades.
Yeah. Well, that's great. That's the low-hanging fruit.
Yep.
Cody,
exactly.
anything we didn't touch on, didn't talk about that you wanted to?
I would just hit on, for everyone, just think really hard about, if you're interested in buying a business, think about what your skills are, in the type of business that you feel like your skills could match up to, or like in my case, maybe you don't know a ton about the industry you're buying in, then assess to make sure that the business can still function and run without you having some of that, more technical knowledge. So yeah, just, I think no right or wrong way to approach it. And, if you were and also if you were debating, I would say going into my search, I would say I'd rather buy a bigger business that was maybe slightly lesser quality. But now looking back, I would much rather buy a super high quality business that was maybe on the smaller side, because I think it's going to just make your life a lot less stressful. So
my napkin math makes me feel like yours wasn't a small business. I mean, it's 25 employees. You the acquisition price was getting into that $5 million range. So, at a 3 or 4 multiple, it seems like there's some good SDE there. So it doesn't feel like a small business. Yep. Were you suggesting that it was?
No, it's not. It's not small. It's not small by any means, but just, we're not doing $2 million of EBITDA, for example,
right?
Or $3 million of EBITDA. It's not a 15
you were
million.
Comparing it to that. Okay.
Yeah. It's not like we're getting into tens of millions kind of thing, which you see on occasion. You see self-funded searchers kind of pull down a bigger deal, and it's just basic math, right? If you buy a $15 million business at 4 or 5 times EBITDA, and you own a majority of it, if you could just keep the thing going for that period of time, it can turn into a pretty exciting financial outcome. So anyways, that on the face of it, that makes sense. But once you're actually in the seat, if a business is that big and you could buy it for that low of a multiple, it's probably because there's probably a reason for it.
And so you've ultimately thought that your end of the market feels great, high quality, but small.
Yeah, and I have other searcher friends, so it's kind of funny how this works, but as a searcher, I feel like you develop these searcher cohorts, almost if you were doing your MBA and you started out. If you start your MBA or you started college or high school and you're starting searching at the same time as, maybe 4 or 5 other people, and you sort of develop this bond and friendship that's kind of unique. And so some of my other searcher friends who I started searching with, some of them are still out searching, and we're just always chatting about these types of decisions. What about this business? It's pretty big, but it has some customer concentration and a lot of new construction kind of centric business, and versus there's this other really cool maintenance, recurring necessary niche maintenance service business, but it's kind of small, and I would prefer to buy that smaller, really cool business that's kind of more high quality. And then the goal is just like, all right, well, how do we grow this thing fast? Right.
Yeah. Great, Cody. If people want to reach out, how do you prefer they do that?
You can find me on LinkedIn. Just my name's Cody, Cody Agee. I think I'm also on X or Twitter. I think my handle's Cody WAG there. You can email me, Cody@splitmountaincapital.com. So
all right.
Always happy to chat with any searchers. I did hundreds, probably, 100 kind of intro calls with all kinds of investors and searchers and people in the ETA community before I did this. So happy to do the same.
Awesome. Take Cody up on that, folks. Cody Agee, thank you very much for coming on and sharing your story. Congratulations on getting a very high quality business, what seems like a very high quality, cool business.
Perfect. Thank you all.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come, stories that will help you along your own path to acquiring a business.